Xi Jinping's pledge to revive growth is finally winning over some investors who have been burned time and time again by China's economic woes. Stocks like that of Chinese EVs and Alibaba have performed decently well for 2023 compared to what they did last year, but they have been grossly outperformed by their US counterparts. And the latest data shown from the Politburo conference might be telling us that could be ending soon. However, as I'm sure you're already aware, I like to find opportunity in pain. And with the way that current Chinese stocks are underperforming, chances are that over the next few years, you are going to get much better returns in Chinese equities than here in the US. Yes, folks, I do sound like a broken record when I've said that, because I've made plenty of videos covering the Chinese market over the last 2 years, and it turns out that my videos have a very minimal effect on Alibaba and Xi Jinping. However, folks, it's also pretty obvious that I would not be here where I am today if I had not stuck to my conviction in any one of the companies that I've invested in over the past few years. No one stock is going to make you a millionaire, but a basket of high quality stocks that are picked during the right market cycles indeed can. And it's exactly that kind of cyclical opportunity that I'm seeing right now in Chinese tech. And in this video, I'm going to explain exactly why that is the case. The first and most obvious reason is the fiscal and monetary stimulus that is expected from the Chinese government anytime soon. Just 1 week after we learned that China's second quarter GDP grew at only 6.3% versus 7.3% expected, the government is laying out new plans on how it wants to boost consumption in the broader economy, which has slumped more than expected since the recovery started in October of 2022. And as you can see, folks, although that recovery resulted in a significant rally in Chinese equities, which rallied more than 60%, so far in 2023, most of those gains have been wiped out. And it's for good reason, because the economic data is simply not correlating with what markets had expected. However, where many people see an opportunity for more failure, I see an opportunity to invest, because no bear market has ever ended with most people turning bullish, and in my opinion, this is no different. You see, folks, not only is China one of the most important economies on planet Earth, but they have historically always sacrificed profitability and economic prosperity for growth. And this year is going to be no different. Based on the sell-off we've seen over the past 2 years, the Hang Seng's average weighted PE ratio, which is essentially the most important valuation metric known to mankind, is sitting at 12x. That is way below the average that we've seen since 1970 of around $15. And that is to include the fact that the Hang Seng Index in and of itself has been basically sideways for the past 16 years. And as the pandemic has shed light on, there's a very simple reason for why this is happening, and the government in China is finally starting to realize it. Because for the first time in its near-term history, the government of China is expected to introduce stimulus not for infrastructure, but rather for consumption. Here in the West, the US's success is mostly attributed to a GDP that is dominated by consumption, whether that be buying retail goods or physical products or even intangible services. Consumption from the consumer is the number one reason America is where it's at today. And that, unfortunately, folks, is something that China can't necessarily say about itself. Since the great financial crisis of 2008, the Chinese government's main focus has been to invest in innovation, manufacturing, and technology. It's the sole reason that China is the main supplier of the chips and components across most technology companies, and one of the biggest reasons it is the second biggest GDP on Earth. And because of that, not only is the US-China relationship from an executive perspective getting stronger so far in 2023, but the government itself is realizing that to catch up with those in the West, they have to invest in the consumer. And with their youth unemployment at a record high of more than 21%, that is exactly what they are now set out to do. And although indices are not the best way to judge the potential performance of your Chinese investments, as you can see, the correlation between the Hang Seng index and that of the S&P 500 has been at its worst in all-time history. Correlation topped at more than 22 in 2010 and is now sitting at 4.17, which not only is primarily attributed to the consumption-based and big tech market bubble that we've seen in the US, but also attributed to the lack of innovation in Chinese companies. And with stocks like Alibaba trading at valuations and prices that we haven't seen since their initial public offerings in the US, this kind of correlation is creating an ever-growing opportunity for potential investment upside, even though yes, since 2021, it's been very difficult. And guess what, folks? Not only are the technicals signaling a potential bullish move over the next couple of market cycles, with stocks like NIO, XPeng Motors, and even Alibaba having formed month-long bases, but the Chinese government is also, for the very first time since the pandemic, taking action on its economy. The government is expected to focus on expanding domestic demand, boosting confidence, and preventing risks in their economy. The Politburo meeting, which is essentially the Communist Party of China's annual economic meeting, had just taken place on Monday, and most of these details are revolving exactly around what investors want to hear. A bunch of stimulus will be introduced to boost residents' incomes, which have struggled since the recovery and lockdowns of 2021. Meanwhile, bond issuances and lower interest rates should help more businesses not only start up, but also continue to grow, which has been a struggle for many companies. On top of boosting demand for the likes of automobiles, electronics, and household products, the government is also going to take action on its most important lever, which is the property market, which, with the Evergrande collapse of 2020, has set forth China in a downward spiral. To hit its target 5% growth rate for 2023, the government is vowing to optimize property policies in a timely manner in response to significant changes in the supply and demand relationship within the economy. This will not only help reduce local debt repayment burden that many businesses in the country are facing, but it will deleverage the economy, meaning the ups and downs both will be softened. All these factors, in my opinion, will come together to start the stage 2 bull market cycle that many people are not expecting from Chinese equities. This basing that we've seen in stocks like XPeng, NIO, and Alibaba is something that we simply cannot ignore, and most likely signals the start of institutional accumulation in these names ahead of the economic stimulus we are just expecting. And that accumulation is clearly visible not only through the big banks like Deutsche Bank, Bank of America, and Morgan Stanley increasing their bullish outlook, but funds like Michael Burry's Scion Asset Management adding JD.com and Alibaba to their already extremely risk-averse portfolios. So, what do you guys think? Is China an opportunity or an opportunity to stay on the sidelines and protect your cash? As usual, folks, let me know your thoughts on the situation down in the comment section below. Thank you very much for watching, and I'll catch you guys in the next one. Take care.